Good morning, Doug.
Hey, good morning, Keith.
It's a beautiful day. The stock market is going to do what it's going to do. Life is going to do what it's going to do. I added on the disclaimers there that wisdom offers better leadership than titles do. I just thought all the things I've seen this week, it just seemed to be the appropriate disclaimer.
Like when I think of titles, are you thinking of like descriptions of what people do for a living or professional?
Exactly.
Okay.
Yeah, like if my title was the Federal Reserve Chairman or the Treasury Secretary or a bank CEO, all those titles don't necessarily engender true wisdom, if that makes sense.
One of my friends was high up in leadership at a publishing company, and one of the things that he would say to his team that I always liked, he would say, "There are no adults in the room," and implying that someone here has to make a decision. Someone here has to go for it and think differently.
Yeah, I sent you this meme earlier in the week, and it's kind of why I was thinking that way, is that
Yeah.
the the idea of a one bank treating individuals in an honorable way when they're really mismanaging, not all banks, but there's clearly, when we have too much cash in the economy, like the Federal Reserve let happen, then banks get careless. And this isn't a new idea. This is a cyclical thing, probably a 15-year cycle where banks just get careless and do things. One of our clients had more money than was FDIC insured in a bank when all this started, and I recommended to him that he split that up in thirds. And so he put a third. Well, I can't remember if I showed you all this list or told you all about this list. It's the 2022 list of global systemically important banks. Did I talk about this before? They call them GSIBs.
Yeah, we did.
Yeah, so there's 30 of these across the country or across the world, and so I told him to split them, his $750,000 in three of those, just for the time being. And one of them was in the group 3. There was nobody in the they call them buckets, bucket 5, 4, 3, 2, 1. I think 5 is supposed to be the healthiest. 4, the only one in bucket 4 was JP Morgan Chase, and then 3 had 3 banks in it, and 2 had 6 or so, and then the remainder in bucket 1. Well, one of the bucket 3 ones, he put the money in, $250,000. A week or so after that, he gets a form letter from him telling him we couldn't identify you, and so we're closing your account out. And I thought that was just really interesting that for that much of a deposit, nobody picked up the phone, nobody did anything. But I think as the economy goes through these banking challenges, these global systemically important banks probably will become less important because people will get tired of that kind of action, and the regional banks and the local banks will gain favor again. That may happen, but ironically, one of the 30 was a little bank over in Europe called Credit Suisse. And so just getting the title of being on one of these doesn't mean it's necessarily a great place to have your money either.
Yeah, that's really wild.
So what do you think about the Fed Reserve this week?
Well, a couple thoughts. We've shown. I'm gonna pull up a chart. Do you mind if I take control of a chart here real quick?
No, I'm not sharing anything.
Okay.
There you go.
Yeah. So we're looking at the supply of money with this chart, and if you can take a look at this chart's really an interesting chart. It covers a lot of ground. It goes back to 1950 something over here, and then it fast forwards all the way to 2023. And one of the things that Keith and I have talked about for a while now is just, if you can take a look at a chart and then quickly determine its trend, that's probably a lot of what you need to know. And so what you can see here is just the creation of money. As some say, printing money. It could be just adding commas and zeros into our world, but you can see the escalation of the supply of money really has picked up over the years. And if I change this date from 1959 to, let's just say, 2019, you can see a real boost during the pandemic, and when government started to shut things down and had to create programs to keep rioters from the streets. And so what this tells me is there's just a lot of change happening in our system. And in regard to the feds, this is an article I ran across from our friends at First Trust. Brian Westbury is chief economist there. And he pointed out that before the panic of 2008, the Fed had total assets of 875 billion. He says that's billion with a B. As of Wednesday last week, its assets totaled 8.6 trillion. And so in just a pretty short period of time, 875 billion to 8.6 trillion. And it's really hard to quantify that amount, but it's just tons. And so I think what we have, you ask my thoughts on the Fed. I don't know if you're asking about interest rates or, the hike this week. I think the hike this week was pretty predictable. But what I think really more long-term is just what's the effect of all that new money out there into the system. And it creates some headwinds. It goes against the supply and demand that we're raised or thought of, or we think of when we think of economic things.
Yeah, I think you're right. There's this isn't a recommendation to buy or anything. It's something that we're watching. But when you see the activity, this is a ETF reflecting gold prices, and all of this motion from the 170 level to 185 has happened as a result of what the Treasury and the Federal Reserve have been doing with the banking challenges. And you don't usually like to see people run into gold, but I think that is one way that they vote about what they believe is going on out there, is they're looking for a place. If you turn on the printing presses and you have more money than you did yesterday, it dilutes the value of today's money that you have. And in the stock market, where we see that is if you own shares of a stock and the company issues more shares of that stock, it's the exact same process. And normally what you'll see is if a company has 1 million shares, which that's a pretty small number, but if they issue another 100 million, another 100,000 shares, that takes your one share and depreciates the value of it by 10% roughly. And so and you'll see that in the stock market that quickly. The market doesn't like it and it votes very quickly. Well, consumers who are holding dollar bills don't necessarily have the wisdom that the market does. The market is not patient. The market is not, it's not concerned about your feelings. The market is just saying, what's the reality of the situation to the best that we as a market can gather, and then they vote immediately. And they may vote wrong for a while, but eventually, usually they're closer to the reality of what's going on than what the average consumer is.
And that's another thought too. What's your opinion on the Fed? What's your opinion on interest rates? And so everyone's got an opinion out there this week. If you watch any of the East Coast stock market shows, or you listen to them on the radio or a podcast, or you're following certain people on Twitter, everyone has an opinion on what could be done, what should be done, what should have been done. A lot of rear view mirror looking. And even the best of the economists out there, they're trying to make some type of forecast. And these people are so smart, they're so intelligent, they've been to the right schools, They have so many hours in studying theory, but the great thing about tracking price and volume is this is how people are voting with their wallets, and that's really what matters. And so as we're managing money, we want to protect at times, and there's other times where we're aiming to grow. And that's the beautiful thing about the stock market. There's a lot of places an investor can turn to try and grow capital. And there's a lot of places an investor can turn to try and pick up some income. You could buy a farm, you could invest in a business, you could buy a rental house, you could, you could buy cars and rent them out during the week. I mean, there's a lot of ways that a person can choose to grow or gain income on their investments. But the beautiful thing about the stock market is it's liquid every day, 9:30 to 4 o'clock. I mean, we've had a few hiccups. I know that we all remember those, but it's liquid. You can get your hands on your money, and those are people voting. And so even though folks are trying to guess and forecast what's going on economically, and Keith, I know you and I like to talk about that, and hopefully we don't complain too much, but really, at the end of the day, what's the stock market telling us? And for several months, it's told us, be cautious out there, protect capital. And for the first time in a lot of months, a lot of years, the stock market has some competition with fixed income assets. And we've seen that play out in the banking sector. I mean, just imagine if you were a bank and you are getting next to zero on your money, and now, to hold some bonds, you're getting over 4%. That's pretty good. And so it's the same thing is true for investors, is they have choice. And that's what gets me really excited for all of our clients is you have choice. You can place your money in a lot of different areas. And there's times where we want to grow it. There's times where we want to protect it. And we've been in one of those modes.
Yeah, those are really themes that I had laid out in front of me with some of my notes, Doug. That was a great lead in. If the Federal Reserve knew what was going to happen, we wouldn't be where we are. They wouldn't have over extended cash, and then they wouldn't have to aggressively draw it in, which shows which banks when they start raising rates, it quickly shows you which banks have been swimming naked, and then they try to act as though they can save it, which they can't because it's already a problem. So one of the quotes I was looking at from one of our friends this morning, and he said, "We don't know the future." And when I was reading this quote, I was thinking, you can think about it at the market, or you could just think about my daily life, like whatever I've got going on today. It applies to both. It says we don't know the future. When we accept the fact that we don't know the future, we see the future more clearly, and we simply get in line with what is. If I take that away from the market and say I've got a rebellious child, and my inclination is I want to fix that rebellious child. But what if I accept the idea that I have this rebellious child, and this is going to take time, and I'm not going to fix it today? Maybe my shoulders won't be as stressed. Maybe I can think more clearly, love better, and things like that. But his quote wasn't talking about anything like that. It was talking about the markets themselves. And so then we don't know the future. But I thought this was funny, a funny slide that I found from this week's Federal Reserve. This chart was released 2 p.m. on the 22nd from the Federal Reserve, and these are these little dots here are all the Federal Reserve banking people's estimates. So a dot would recommend their estimate. These numbers are pretty small on the right, and so one of the banks was thinking that, what is this, 5.5? So that's 5 3/4, and this 6%. So if you can't see this number over here, this is 6%, 5%, 4%, 3%, and 2% down here. So all the voting members represent a dot, and where they think that the interest rate should be at a different point in time. And so that right now they're thinking that somebody thinks it should be over 575. One of them thinks it should be 475, and then a lot right at the 4 and 5.25 level. And then over here shows where they think it should be in 2024, 2025, and longer term. And so only in 2025, only one of them thinks that we should have interest rates at the level where we're at today, and the rest are thinking in 2025 we're going to have interest rates pushing back down towards 2%, and in longer term they think it's going to be in that 2 to 3% range. And so that's what we call an inverted yield curve, which those tend to precede economic slowdowns. So that was I thought that was a really interesting picture from what they're predicting, which they aren't going to be right. I mean, they could be, but their possibility of being right, I had a quote here, isn't going to be this bad, but this says, ahead of March Madness, every year we'll think we have the perfect bracket. You and I might think that. I don't really think that. But the odds of getting every game correct are 1 in 9.2 quintillion. So that's a number with 1, 2, 3, 4, 5, 6 sets of 3 digits and then the 9 in front of it. So if you just drew a 9 and then followed it by 18 zeros, that's the probability of getting the March Madness thing right. And it's not that far off for the Federal Reserve from that, but they're not going to get it right. So that's why they're going to cause the economy to swing differently than it would on its own.
Well, and the effect of that is this. So here's the S&P 500, and this day, all these days looking to the left of this chart are absolutes. Those are done. Those are priced in. There's no forecast happening there. And you could say, well, Doug, you don't want to invest looking in the rear view mirror, and that is true. However, this can be part of our guide, and the way it can be our guide is we can look at the price, where the money landed that day. We can look at the participants down here, who's getting excited about it. Is it a buyer? Is it a seller? And then those trends tend to stack, and we have a picture of what's happening. And again, like we talked about that first picture when we looked at the supply of money, you could look at it just quickly and say, hey, the supply of money has been increasing. And if we take a look at the S&P 500, look at this. What a great and fantastic run right here. And hey, who's to say we can't have those again someday? But what a sell-off right here. And so this is the picture that we use to help guide us into decision making. And when we zoom into this, we see these prices are really going back and forth along this 200-day moving average. And that's okay. And it's okay to sit tight. I mean, one of our good friends, he would tell us that sitting power is one of the most difficult things to learn when you're an investor. And it was probably been true since childhood, unless you were just a really good saver. But if you had some things out there that you wanted to buy or wanted to spend your money on, or maybe you're an investor, you've got some prospects that you like, and you're thinking about the future. Learning to sit is truly a discipline. And that discipline for us is what are the prices doing along this 200-day moving average? And they're voting, and they're telling us not a whole lot.
Doug, pull up the NASDAQ. I want to show that in contrast. It looks to, if you look at the slope from that November 2021 high all the way down to where we had the rally above the 200-day there, Doug, if you can draw a line from that.
Like here?
Like right there, yeah. down to that 12.6. Yeah, so if you put it right there, that's kind of the slope of what the NASDAQ is doing. It's showing that little RS notation right below where you stop there. That shows you that it's showing a little bit, relatively speaking, it's showing a little more strength than what the S&P 500 is doing. And really positively looking at where it's at down. If you go down to the volume down below and just draw a line across the last 2 or 3 weeks of volume, there's a lot of blue coming in there, which that blue for the last, well, it's probably been a week and a half, is just showing that money is coming more likely in the volume on the NASDAQ than the S&P 500. And then if you click the weekly on that, Doug, you see a few more blue weeks of volume down there. So there's some blue volume coming into the NASDAQ. And when I just glance at it, it looks like 2 or 3 of the last 6 or 7 weeks were red, maybe 4. And then if you contrast that kind of volume on the weekly with the S&P 500, there's a lot more red on the S&P 500 stocks down there, not as much volume kind of picking up. So it's suggesting that any money that's coming into this market right now is coming in those traditionally more aggressive stocks, which that's a good sign. So if we do sound pessimistic, it's not that we're pessimistic. We're really optimistically watching what's going on. And I think even the tone of my voice today is just tired. I was out late last night, and so I'm still waking up. So
yeah, you had a good night last night. Keith's youngest daughter got married on a Thursday night. You talk about a trendsetter. That was, Thursday night. That was the night that we all went out in college during college days. And so, it was a great kickoff to the weekend. A lot of fun. And Keith, here's what I was thinking, like you put up wisdom offers better leadership than titles do on our disclaimer. I'll stop sharing this for a second. And I was thinking about that. I was thinking, okay, well, where does wisdom come from? And experience is not the answer, because there's been a lot of people who've married off a daughter who sent their kids to college, who've lost a parent, a lot of who's had a child born, a lot of great life events. They got fired, they got hired, a lot of great life events, and those are all experiences, but it doesn't mean you have wisdom. And so if we go back to that, and wisdom offers better leadership than titles do, where does the wisdom come from?
Is that a rhetorical question, or are you asking me?
I mean, how do you get it? And,
Okay, go ahead.
Yeah. And so everyone on this call, I get to see you, I get to see our list of attendees, and I'm just looking through the list and thinking, man, these are some really wise people out there. Had some great conversations. We've done several life events with you. And so wisdom is such a divine gift, and that any fool can ask for it and then receive. And a lot of that wisdom comes from just listening. And one of the greatest things that I've been enjoying over the last several years has been listening to the stock market, instead of trying to get ahead of it, instead of trying to guess, instead of trying to, well, this is what my friend thinks, or this is what I saw. And so I've really been enjoying the wisdom that you can learn from the market. And most of the time it comes from people. And so I did bring 2 books out.
Nice.
Yeah, Peter Lynch. Boy, what a brilliant mind in the stock market. Peter Lynch, he really ramped up a fund, the Fidelity Magellan Fund. This is not an advertisement for that fund. I'm just telling you what Peter Lynch, what he accomplished. And people in this industry share their wisdom with us. David Malik, what a great man David Malik is. He shared the wisdom with us that you want to know what you own. You want to know what you're going to buy and what you're going to sell. these seem like obvious things, but in our industry, that's not the case. In our industry, it's buy it and hold it and hope it works. And so it's great to see so many people sharing their wisdom, and it's not just through experience.
I was watching a Netflix special on Bernie Madoff, and um, I have strong opinions on a lot of things, and so when I watched it, and I don't know if it's 50% correct or what, you know, any kind of thing that's a documentary, it's biased one way or another. But one of the things that really intrigued me, there was a fellow that his boss came and told him, whatever Madoff's doing, you need to replicate this for us and make it happen. And this is a mathematician. He went through all the data and then he said he can't do this. This analyst that was supposed to replicate it, and they told him that wasn't acceptable. So he put together a strategy that would replicate what Bernie Madoff's doing on the upside, but the only way he could get the upside was to offer people 50% downside risk at any one point in time. And he had a few people take it, but everybody said, why would we take 50% downside risk with you if we don't have that with Bernie Madoff? This was months and months and months, like 5 or 6 years before the regulators finally caught him. The same guy took a list of like 20 things, specifically outlined them, and took it to the SEC and said, here's why this is a fraud. Probably, I didn't figure out how many months it was. It was probably 3 or 4 years before they caught him, like billions and billions of dollars before they caught him. And the SEC had a blind ear, blind eye to what was going on, or they didn't understand. They even sent regulators into Bernie Madoff's office, and these two people sat with him. He calls the SEC and tells them, hey, I got all this taken care of, this is good. And so they call him off. And so that's part of the whole idea of a title. There is wisdom out there. That fellow that understood that this cannot be done and said it, nobody wanted to listen to him. But oftentimes that's what happens with wisdom.
Yeah. Well, hey, I want to wrap it up, Keith. I know we're really privileged to walk alongside of people in this journey and share the adventures that you guys have had, and encourage you to have more adventures, building your legacy effect. And that's one of the most exciting parts of life. And so thanks for joining every week. We'll be here, or Keith, you'll be here next week. I don't know if I will or not. I'm probably going to be rolling down I-75 somewhere, but want to encourage everybody to tune into these, and then also pay attention to the monthly newsletters. Keith spends a lot of time writing the monthly newsletter. Keith, have you always been a good writer, or is this something that just developed over time?
It developed with a lot of practice. We probably have a archive of hundreds and hundreds of these. So you imagine writing hundreds and hundreds of those, how feedback helps to improve the skills. And then even I think even just maturity, you know, as a young man, I wouldn't want to write anything that might irritate somebody. But if I have wisdom to offer and it offends you, would you rather me share that or keep it to myself? And so that's been kind of the attitude I've taken the last 5 or 10 years when I've written them. But I would encourage you on this one that's going out in the mail probably in a week to read closely. Doug's friend Blake Brewer, I mentioned him in there about the Legacy Letter Challenge, and that I printed off the outline that Blake has in there. But basically, what it was is write your loved ones a note today, so that you can give them a legacy if something would happen to you unexpectedly, that you express your compassion and desire for them. And he's got an outline that you can have on his website to do that. But watch that. If you're motivated, chase after it. I think it'll be a real gift to your family.
All right, everybody. Thanks again for tuning in, and we'll see you next week.
Take care.
All right. Bye-bye.